An investor is preparing to acquire a £600,000 premium warehouse. It is a clean, straightforward commercial property deal, but there is a flaw on the application. 6 months ago, the investor registered an unsatisfied county court judgment for £3,000. When this application hits a high street bank, it is fed into an automated underwriting system. The system spots the unresolved debt and immediately kills the deal. This raises a practical question. Does a recent £3,000 credit anomaly ruin a £600,000 acquisition? Traditional lenders rely on binary algorithms. If a single data point falls outside their programmed risk tolerance, perfectly viable commercial deals are stranded at the starting line. To see why that rejection happens, we need to look at how commercial applications are actually processed. Commercial underwriting evaluates two separate profiles. Lenders run a full assessment on the trading company itself, while simultaneously checking the personal credit history of every director involved. An unsatisfied county court judgment stands out because it represents active, unresolved debt. The algorithms used by major banks evaluate the recency of that judgment above everything else. They do not factor in the size of the debt or the context behind it. Getting a deal like this approved requires removing the algorithm from the equation entirely and placing the application in front of a human specialist. This is where specialist commercial lenders operate. Instead of automated scoring, they use human underwriters to evaluate the broader financial context of the borrower. An underwriter looks at the business's earning potential and the size of the available deposit, weighing those assets against the specific details of the adverse credit. This document shows specialist lending criteria. The county court judgments row accepts up to 2 unsatisfied CCJs under £5,000. Our investor's £3,000 judgment fits this threshold. For the added risk, they require a larger deposit, capping loan-to-value at 75%. Bad credit is treated as a pricing variable rather than an automatic decline. It just requires human context to process. Passing the credit check is only the first step. The investor must prove the vacant warehouse will generate enough income to cover its own debt. To solve this affordability issue, brokers use an interest-only commercial mortgage structure. This chart compares both options. Capital and interest repayment creates a heavy monthly burden. Interest-only requires paying only the interest, resulting in drastically lower monthly payments and retained cash. Reducing monthly outgoings generates a higher yield on paper, passing strict debt service coverage ratio tests. Back at the lender criteria, we see how this applies. The matrix shows a capital repayment option up to 75% loan-to-value, alongside interest-only structures at that same limit. With these guidelines, the acquisition is approved at 75% loan-to-value on a 10-year interest-only term. Choosing the correct loan structure is often the deciding factor that turns a borderline decline into a fully funded deal. That lower monthly payment comes with a catch waiting at the end of the term. Because the monthly payments only cover the interest, the capital balance never reduces. When those 10 years are up, the entire £600,000 loan is due in a single lump sum. Lenders know this risk, so they demand a stress-tested exit strategy before they approve the funds. The borrower must provide a detailed plan to clear the debt, whether that means selling the asset, refinancing onto a new loan, or building up a sinking fund. An interest-only structure secures cash flow today, but it demands strict financial discipline for tomorrow. By leveraging a specialist lender and structuring the debt for affordability, the investor secures the warehouse, completely bypassing the barriers of an active CCJ. In commercial finance, a computer-generated rejection is rarely the final answer. It usually just means an expert needs to evaluate the wider financial picture. Please note, finance is subject to lender criteria, full underwriting, and status. Securing these deals requires looking past the algorithms to accurately assess the potential of the asset and the borrower.